It is hard to believe that 2025 is about halfway over already, and it's equally hard to believe that there are weak-handed Bitcoiners who are already fretting about the Bitcoin bull run being over, despite the fact that we are in what has been referred to as open water Bitcoin. We will talk about that and more on this episode of the Bitcoin Bulletin Podcast.
This podcast is for information and entertainment purposes only. Nothing on this podcast should be construed as financial advice. All views expressed on this podcast are solely the opinions of the host and/or any guests that we might have from time to time. Nothing on this podcast should be construed as a specific inducement to make a particular investment or to follow a particular investing strategy.
Guten Tag, buenos dias, Morian, and welcome to episode 219 of the Bitcoin Bulletin Podcast. On Bitcoin Twitter yesterday, I saw more than one person actually predicting that the bull run was once again over, comparing it to the 2021 double top. Most of these, of course, are the same lettuce-handed fudsters that were saying that the bull run was over in January after Bitcoin topped out at the then all-time high of $109,000. Of course, if you've been listening to this podcast, you know that I do not share this opinion and that I believe there are plenty of reasons to expect that this cycle hasn't even begun to start, that we have yet to get to the exciting part. I will expand upon that in a bit, but I also want to remind you that there are people out there who are still willing to trade you Bitcoin for US dollars, or whatever your local fiat currency is, and that sooner or later this will not be the case, that sooner or later nobody will be willing to sell you their Bitcoin for fiat, and that you should stack accordingly. Of course, for those of us living in Florida or elsewhere along the Gulf of America or the Atlantic coast of the southeastern United States in particular, June 1st marks the official beginning of the Atlantic hurricane season. And this kind of puts things into perspective for Bitcoiners, but really there's a lesson here that should be learned regardless of where you're at. And that is, if you are a Bitcoiner, you should celebrate the beginning of hurricane season by making sure that your seed words are protected in a manner that will survive your house washing away. For example, in a major natural disaster, whether it's a hurricane, a wildfire, a landslide, an earthquake, there's a distinct possibility you won't find those titanium plates that you have your seed plate punched into. And particularly if you live on the coast where you might not even be able to find your street, let alone your house. And so while titanium plates are certainly better than writing your seed words down on paper, and certainly better than not having any seed words at all. For example, for those of you who keep your Bitcoin on exchanges still or are using Square's new seedless, quote-unquote, hardware wallet, perhaps it's time to reflect on maybe a better way, one that, of course, suits your needs. Nobody's needs are exactly the same as any other pleb, but there are methods such as geographic distribution, like maybe you use those tiny titanium seed plates, but they're not at your house, far enough away that the same natural disaster isn't going to hit where they are, whether it's a trusted relative's house or an attorney's office or pretty much about anything other than a bank depository, a safety deposit box, because it doesn't matter how secure your seed words are if you cannot find the plates. That's a little bit of an aside, but something that I like to think about every June 1st when hurricane season gets underway here in Florida. Okay, we have a lot of interesting things to talk about today, but of course, before we get into all of that, let's take our customary look at Bitcoin's vital statistics. At the time of this recording, we are at a block height of 899,837, and despite the doom out there on Bitcoin Twitter, we are ringing in at $104,900 US dollars. Of course, that's less than 1,000 sats per dollar. That means that every fiat dollar that you convert into Bitcoin is only going to get you 953 Satoshis. That's about 26, 27 more sats per dollar than we would have gotten last DCA Wednesday because the price is down about 3,000 US dollars. But still, we are above 100,000 US dollars per Bitcoin. Something that last time people were saying the bull run was already over was when it was, flirting with 78,000, 80,000 US dollar range after peaking out at 109,000 and then retracing a bit. One of those 5 to 7, 30% retracements that I've been telling you about over and over again on this podcast to expect during every normal halving cycle bull run if history rhymes or repeats. But of course, we also heard those same people fudding that the bull run is over. Well, first of all, they were saying when $100,000 adjusted for inflation wasn't a new all-time high, or I'm sorry, 75,000 or whatever the all-time high was that time after breaking the previous all-time high, last cycle's all-time high of $69,000, trying to say, well, adjusted for inflation, which I point out is a metric that nobody applies to anything. You don't say adjusted for inflation, gold is not an all-time high. You don't say adjusted for inflation, housing isn't at an all-time high. You don't say adjusted for inflation, eggs are at an all-time high. You don't say, everything is inflationary when you live in a fiat currency society where the currency is continuously debased. So, of course, the U.S. dollar purchases less of everything than it used to, but loosen up a little bit, guys. If you're really worried about adjusting for inflation, you've got nothing to worry about when Bitcoin finally does hit what I believe will be the cycle all-time high later this summer or sometime this fall. It's going to be blatantly obvious that you're at an all-time high regardless of what inflation has done in the last 4 years. But again, I'm getting off on a bit of a tangent. Bitcoin's current price gives it a market capitalization of $2.08 trillion US dollars. So despite the fact we pulled back not quite 5% from the new all-time high, we're still above that nice round magic number of 2 trillion US dollars. So that's certainly cool. Something that I would remind you we've only seen for about 6 or 7 DCA Wednesdays now. So if you zoom out, if you're worried about whether or not Bitcoin is, whether or not this cycle is over, you zoom out and realize that, from a DCA Wednesday perspective, Bitcoin's doing really, really well. For those of you who continue to value your wealth in shiny yellow rocks, it will currently cost you 31 ounces of gold to purchase just one Bitcoin. Everybody gets Bitcoin at the price they deserve. And for Peter Schiff, who is still not a Bitcoiner, that means it will cost him 31 ounces of his My Precious Schiff bucks for every Bitcoin he eventually decides he needs. And that is only going to go up as everything, including gold, trends to zero in Bitcoin terms. But for those of you who value your wealth in something a little more utilitarian, for those of you who value your wealth in pizza, one Bitcoin will currently purchase you 5,866 large pepperoni pizzas from Papa John's. That is that is one pizza every day for more than 16 years, which is 4 halvings out into the future. In 2040, when you're contemplating spending your last few Satoshis, well, you're never going to be able to spend your last few Satoshis on pizza. We've talked about this repeatedly, but if you were to be running out of Bitcoin in 2040, if you really could spend an entire Bitcoin in just 16 years by purchasing one pizza a day, the miner reward in 2040 is going to be cut to 0.195 Bitcoin. That's 19,500,000 Satoshis is the entire Bitcoin mining reward. And I mean, that means that it would take, you would have to find more than 5 blocks to have a whole Bitcoin. And so imagine what 5 blocks is worth right now. And it would be easy to assume that on a worst case scenario, the miner reward will have the equivalent purchasing power in 2040 as 5 blocks do now. Of course, I believe that the price of Bitcoin is going to be significantly more valuable than that. But of course, nobody has a crystal ball and only time will tell. But again, it's going to be the point where if you started spending one Bitcoin by purchasing a pizza a day every day, you're going to see the current all-time high be surpassed by whatever the new all-time high is, maybe this summer or this fall. Then if history repeats, then we'll have a little bit of a bear market and a sideways market, the crab market. And then in 2028, we're going to have the next halving, and that's going to start all over again and set yet another all-time high. And providing we don't end up in a super cycle where we never have another bear market, and then in 2032, the cycle would repeat again. And then 2036, the cycle would repeat again with yet another all-time high. So you get the picture. By the time 2040 runs around, whatever the price of Bitcoin is, it's going to be an infinite number of pizzas when you try and divide that in terms of one human life. All right, that metric that you know has been my favorite metric to follow for the entire history of this podcast, almost 4 years now. Bitcoin's 24-hour average transaction rate is humming right along at a respectable 4.04 transactions per second. Of course, that's down 2.3 transactions per second since last DCA Wednesday, and once again, when the price when the number of transactions on chain are pumping, the price usually is pumping as well. And when the number of transactions per second is down, the price is usually not pumping. And that is certainly true today with 2.3 fewer transactions per second on average, and the price of Bitcoin off by about 5% from its most recent all-time high. Again, not any transaction analysis, just something I thought was, it caught my eye when I was going over the statistics. I like to look at the average transactions per second just to kind of get an idea of how much on-chain adoption there is. When we first started this podcast, there really wasn't much of a Lightning network. Lightning was new. Nobody was using it. So almost everything was on chain. Now, of course, a lot of transaction is moved off chain. Almost every transaction I've done recently has been a Lightning transaction. So the fact that there are still 4 transactions per second is relatively healthy on-chain data. But I started paying attention to that data because I like to get an idea of how much activity was going on. And then I started noticing that when there were more transactions occurring, the price was pumping. And I thought, well, that's a little odd. I mean, obviously that makes sense about 50% of the time, but you'd also expect during a crash, during a bear market, that transactions would be pumping too, as people are panic selling their Bitcoin. I mean, they're moving it to exchanges and dumping it is an on-chain transaction, just like buying Bitcoin and transferring to your hardware wallet is an on-chain transaction. But it really hasn't worked out that way, which is an interesting story to tell whether that actually means anything or not. But speaking of on-chain activity, the mempool is pretty much about where it was last DCA Wednesday. Clark Moody's dashboard is showing 1,794 pending transactions, and mempool.space's mempool is showing 1,814 pending transactions. That's not even one full block's worth of transactions pending, which is cool because it means that if you need to do an on-chain transaction, maybe open or close one of those Lightning channels, or maybe consolidate some Bitcoin or transfer some Bitcoin from the exchange to your hardware wallet, it's going to be a little bit cheaper to do so. Clark Moody's fee estimator is saying that a high priority transaction should include a fee of 5 sats per VByte, but anything from a medium to a low priority transaction could have a 1 sat per VByte fee and still be confirmed within a day and certainly within a couple of days. Mempool.space is saying that any transaction, regardless of priority, it would be safe to include just a 1 sat per VByte fee. That works out to just 15 cents in US dollar terms. And I mean, that makes sense to me because looking back at the last 5 blocks, the last 2 blocks were pretty full because they came in, there was about 20 minutes between blocks. But before that, the block 3 blocks ago had barely any transactions in it. The block before that was mostly empty, and the block before that was about half empty. So as long as there's more block space available than pending transactions, it would make sense that you can get away with a 1 sat per VByte fee, which again is pretty incredible that for just 15 cents, you can send one of the most secure, easiest ways to transfer a store of value anywhere in the world without a third-party intermediary, without using any financial institution, and without the ability for any government or other organization to tell you you can't do that. Since the last episode of the Bitcoin Bulletin Podcast, the difficulty that it takes to find a Bitcoin block was increased rather substantially. Not the biggest difficulty adjustment we've seen during the history of this podcast, but 4.4%, which is on the higher range of what we've seen in the last few difficulty adjustments. For those of you who do not know, Bitcoin adjusts how hard it is to find a block once every 2016 blocks, with the idea of keeping blocks coming in at an average of once every 10 minutes. When blocks are coming in too fast, which is often the case because just like if you zoom out far enough, the price of Bitcoin is going up and to the right. If you zoom out, despite the fact that sometimes there are ebbs and flows, in general, the amount of computing power securing the network is constantly going up and to the right as well. So it makes sense that in general, we're going to be looking at difficulty increases. And we're currently 1,315 blocks away from the next difficulty adjustment, which is about 9 days from now. It looks like that's going to be on June 19th. And currently, depending where you get your data, it's estimated that is going to be one of those times where we see a slight decrease. I personally think it's still too early to say. We just had a very big difficulty increase, and now we have basically 2 weeks worth of transactions that have to shake out, that have to be mined before we have a really fair perspective of just how fast blocks are coming in, because finding the next block is really just random chance. And that's why Satoshi decided that we were going to wait every 2016 blocks before we took that average. So we'd have a bigger data sample, a bigger data set to have a much better idea of what exactly the average block time is. So just like like 3 DCA Wednesdays ago, it was looking like we were going to have a small decrease. And then last Wednesday, it was looking like we were going to have a modest increase of anywhere between 2 and 3%. And we ended up with a 4.4% difficulty increase. So in the next 9 days, it would be reasonable to assume that additional hash power is going to be poured onto supporting the network, and that maybe we won't see a decrease at all. But for the time being, it looks like if you had to guess or place your bets, we're looking at a very minor difficulty decrease, maybe peeling back some of the increase that we just had. But we'll have to wait and see. And the reason why it's looking like we might have a decrease is because blocks are currently averaging 10 minutes and 20 seconds. Obviously, that's slower than once every 10 minutes. Again, there's only been about 700 blocks mined since the last difficulty decrease. And sometimes, blocks can come in so slow that there's only a block once every hour. I just mentioned that the previous block before the last one took 23 minutes to mine. So that is why Satoshi decided that we're gonna have a bigger sample set before we determine what we're gonna do, before Bitcoin determines what it's gonna do with the difficulty increase. Maybe by next DCA Wednesday, we'll have a better picture on what that's going to be. And again, this is really only important if you're a miner, because if you're a miner, it determines whether you're going to be slightly more profitable or slightly less profitable. Of course, the price of Bitcoin has a lot to do with that, probably a lot more than the 3 or 4% more or less Bitcoin you might be mining based on the difficulty adjustment. If you're just a pleb and you have an important transaction to send, regardless of what the difficulty adjustment is, the next block could be found in a minute or it could be found in an hour and a half. It's just really, really random chance. And there's so much hash rate securing the network now that 4% plus or minus either direction really doesn't make much of a difference when we're talking about the most secure computer network ever envisioned. Speaking of which, the 90-day average of computational power securing the network is up about 7 exahash over last DCA weekend. Now it's estimated there are 864.8 exahash securing the network. So you get the idea of just how much computing power has been added to the network just since we started doing this podcast. I mean, it was only a couple years ago when we were in the 400 exahash range, and we've more than doubled in about 2 years the amount of exahash securing the Bitcoin network, and that's a trend that I fully expect to continue. Real quick, I want to take a minute to thank those of you listening on your favorite Podcasting 2.0 apps such as Fountain. Podcasting 2.0 allows you to contribute value back to this podcast by either streaming sats while you listen on a minute-by-minute basis, or by sending a boost, which is a shout-out via a Lightning transaction, where you can say hi, let us know what you think about the podcast, say whatever you want, really, but because it is a Lightning transaction, you are sending value back to this podcast in the form of Satoshis. Of course, when we do receive boosts, we read them on the next episode. We do not have any boosts to read this week, but thank you to those of you who have continued to contribute to this podcast, to continue to contribute value back to this podcast. But even if you don't have any Satoshis to contribute back to this podcast, you should still listen via Fountain, in my humble opinion, because Fountain will actually pay you Satoshis to listen to podcasts. It's completely random, and there were about 5 days in a row where I didn't receive anything, but then there were a couple where I got 100 or 200 sats just for listening to my favorite podcast. So randomly, they decide how many Satoshis per minute you're going to earn for the first hour that you're listening. I know 100 Satoshis, 20 Satoshis, 10 Satoshis, whatever that may be, might not seem like a lot. But one of the reasons I think Fountain is appropriate is because Fountain kind of reminds me of Faucet. And many years ago, there was the Bitcoin Faucet where you could receive 5 Bitcoin just for going to a web page. And everybody thought, well, that was kind of worthless, right? Bitcoin really didn't have any US dollar value. And what was 5 Bitcoin? Of course, 5 Bitcoin today is worth more than $500,000 US. And one day we're going to talk about Satoshis kind of in a similar manner. Certainly when Bitcoin hits $1 million, it won't be quite that extreme. Maybe we'll be talking about, a dollar or two for listening to your favorite podcast. But when Bitcoin hits 100 million or more, we're going to be talking about $10, $100, maybe even $1,000 just for listening to your favorite podcast. And of course, it's a podcast you're going to listen to anyway. You might as well do so on a network that supports plebs, that helps plebs support their favorite podcasts through Podcasting 2.0, and that'll let you, earn a few Satoshis just for doing so. Speaking of our listeners, our geographic distribution of listeners has remained kind of ossified the last several months, and it tends to do that. It seems like we'll go 6 months or a year without any mix-up, and then out of the blue, something will explode. A country will explode into the top 10, which we had most recently happen with Singapore, having been not on the top 10 at all, and then zooming up as high as the number 2 spot. So currently, our top 10 countries where our listeners are located remains as follows. Number 1 is the United States of America, where about half of you are listening. So hello, and thank you to my fellow Americans listening from right here in the United States. Number 2 remains Singapore, as I just mentioned, that exploded into the top 10 a few months ago, all the way to the number 2 spot where it remains. So apa kabar, thank you to those of you listening in Singapore. Number 3 remains Germany, so Dankeschön, mein Freunds in Deutschland. Number 4 remains Argentina, so hola, muchos gracias amigos in Argentina. Number 5 remains Luxembourg, so Dankeschön, mein Freunds in Luxembourg, or Morgen to those of you speaking Luxembourgish. Number 6 remains our neighbors up north in Canada, so hello and thank you to those of you listening just north of the United States in Canada. Number 7 remains our cousins across the pond in the UK, so hello and thank you to those of you listening in jolly old England, or wherever you find yourself in the UK. Number 8 remains Spain, so hola, muchos gracias amigos en España. Number 9 remains Australia, so hello and thank you to those of you listening down under. And number 10 remains Mexico, so hola, muchos gracias amigos en Mexico. And hello and thank you to everyone listening, even if your country is not in the top 10. There are quite a few countries lurking just below the top 10 where it might only take 1 or 2 more listeners to bump your country into the top 10. So if you are listening in a country that I did not list, if you get a friend or family member to listen to this podcast, it will help support the podcast, even more so than contributing sats, and maybe it'll be enough to boost your country into the top 10, and that would be really cool. All right, on to the news. Oftentimes, the news is the price and the price is the news, and really that's not the case as far as what most people are talking about. At least this week. Last week was a huge week with a lot of exciting announcements as the conference was underway in Las Vegas, but this week has had its fair share of important announcements too. Today, for example, Yahoo Finance ran the headline, Michael Saylor's Bitcoin imitators are multiplying, from Trump to GameStop. Michael Saylor's imitators are multiplying fast. Dozens of publicly traded companies, a media firm controlled by President Trump's family, and a meme stock poster child, GameStop, are all piling into a bet that Saylor used to turn a business intelligence software firm into a Bitcoin juggernaut called Strategy. The blueprint developed by Saylor is to use a combination of debt and equity to add Bitcoin to a company's balance sheet, and lots of it. Since Saylor first announced his plans to do so in August of 2020, it's hard to believe that was all the way back in 2020, but of course it was, because this was Saylor's first halving, will be Saylor's first bull run, the bull run that I said will vindicate Michael Saylor and MicroStrategy. Since Saylor first announced his plans to do so in August of 2020, Strategy has spent $40.7 billion to amass more than 580,000 Bitcoin and become the largest corporate holder of the world's largest cryptocurrency. It goes on to talk about the stock performance, which I'm not really concerned of, and that the stock performance is kind of the point of the article, and I don't think that's Michael Saylor's point. Remember he was trying to preserve that melting ice cube, the melting iceberg, his pile of cash, as he told us over and over again. He wasn't really trying to pump his price stock. That's just been kind of a benefit that's allowed him to unlock the playbook that he's using, but wasn't necessarily his original intention. So the article continues, now many imitators are trying to replicate that stock price success with their own big bets. Again, my words here, I don't necessarily think they're necessarily trying to replicate the stock price pump. Surely some are. There are surely a lot of companies diving into Bitcoin treasuries because they see the number go up in their stock price, and they're not fully really orange pilled in the way that Michael Saylor is yet. But the nice thing about Bitcoin is you don't change Bitcoin, it changes you. So a lot of people get into Bitcoin for the price, for the fiat price, and then they do the research, and then they become laser-eyed maxis, and that'll happen on the corporate level also. But I digress. The article continues, since 2023, public companies have increased their exposure to the digital asset by 160% and now hold roughly 3.4% of all Bitcoin in circulation, according to Bernstein and Gautam, and according to analysts. In all, 80 companies have adopted the so-called Bitcoin standard by holding Bitcoin as part of their treasury reserves. So this is kind of that gradually then suddenly thing. Of course, when Parker Lewis wrote that article, he was referring to Bitcoin adoption in general, not necessarily corporate adoption, but that's certainly a part of it. Fidelity Digital Assets tweeted out today, an increasing number of institutions are leveraging Bitcoin as a strategic reserve asset. And as understanding of the asset deepens, interest continues to grow. See what may be driving the shift, and then a link to their article titled Adding Bitcoin to a Corporate Treasury. And of course, that's from Fidelity, which is something that we could have only dreamed of in the previous cycle. Eric Semler tweeted out today, Semler Scientific acquires 185 Bitcoins for $20 million and has generated BTC yield of 26.7% year to date, now holding 4,449 Bitcoin. So Semler Scientific, among those companies going headlong into Bitcoin FOMO. CoinDesk ran the headline earlier this morning, and I've got my reasons for not liking CoinDesk, but they do have some good headlines from time to time. And this one is Bitcoin Treasury News. K-Wave Media aims to be Korea's Metaplanet. Aspiring to become Korean Metaplanet, K-Wave Media is selling $500 million in common stock to fund initial purchases. So K-Wave Media is a K-pop media company, and apparently they're diving headlong into the Saylor strategy, selling $500 million of the common stock to purchase Bitcoin. So they're not even issuing debt. They're just diluting their shares. And that is cool. So another company diving headlong into Bitcoin. $500 million of the Bitcoin might not be Saylor level money, but imagine the previous halving talking about someone purchasing $500 million of the Bitcoin, whether it's a person or a company, and how that would have moved the price, because that would have just been insane to even think about. And here we are with it just some other company jumping on the bandwagon. Of course, one of the reasons I hate CoinDesk is because they're not, I believe they're an S-Coin company. I've got plenty of reasons to believe that. But here's just an example. In the same wave, just 2 days ago, today they're talking about, the bit corporate adoption. But here's how they framed that just 2 days ago. A headline, BTC News, Bitcoin weakness fails to stop corporate adoption wave. Bitcoin weakness. Who out there listening to this podcast think Bitcoin is weak right now? We're over 100,000 US dollars, hovering right around 105,000 US dollars, a number that had never happened before just a few months ago, before this year. The previous all-time high was $69,000. We've almost doubled that, not quite, but we're significantly higher than 69,000 US dollars, and CoinDesk is calling Bitcoin weak. So I try not to cite my news from CoinDesk, but they had some good headlines this week. Along those lines and along that rant, Bitcoin has held the $100,000 price for almost a month now, 28 days to be exact. That is just insane to think that, that people are out there saying that this is a double top, that Bitcoin is topped. Plebs, a blow-off top doesn't look like setting a new all-time high and holding it for 100 days. When we hit the all-time high in 2017 at 20,000 US dollars, it lasted for minutes, and then Bitcoin rapidly started plummeting. When we did the same thing at the end of 2021, when Bitcoin hit $69,000, that was it. We went all the way down to the teens, not instantly, but Bitcoin retraced all the way back to like 16,000 US dollars before it was all said and done. It did not linger at $69,000 for a month. This is not what a blow-off top looks like. Of course, it isn't just corporate adoption that's accelerating. Russian Sberbank announced today that they would be issuing Bitcoin bonds, or at least Bitcoin structured bonds. Sberbank, Russia's largest lender, has launched structured bonds tied to Bitcoin, offering qualified investors exposure to the cryptocurrency's price movements and to the US dollar to ruble exchange rate. The bonds are currently available over the counter and will be listed on the Moscow exchange, expanding accessibility and liquidity for domestic investors. Now, this is not the same as buying Bitcoin, but you have to remember Bitcoin was illegal to trade in Russia not too terribly long ago. The central bank has recently, however, started to allow financial institutions to offer crypto-linked instruments to qualified investors. So regardless of what you think and regardless of Russia and Putin's motives, this is certainly a big shift in Russia's approach to crypto assets and Bitcoin. And, maybe this is representative of a broader shift. I don't think we're looking at a government that is embracing Bitcoin and the freedom related to Bitcoin in any way, shape, or form. But, again, you don't change Bitcoin. Bitcoin changes you. Russia is not going to change Bitcoin. Bitcoin is forcing their hand. And maybe some of it has to do with what's going on in Ukraine and the sanctions and all that. But, again, that's Bitcoin changing you. Bitcoin is for everyone. Bitcoin is for enemies, including Putin. And as much as authoritarians don't like the freedom, the financial freedom that Bitcoin provides its citizens, eventually even Russia has to bow to Bitcoin. And this is just the first crack in that dam. Speaking of financial freedom, and this is only Bitcoin adjacent, it doesn't really have much to do with Bitcoin in general, but the breaking news, I guess this was on May 31st, so 4 days ago, Malay government lifts nearly all restrictions on money transfers and purchases, saying, quote, "Your dollars, your decision," with Bloomberg running the headline. Malay ARS to USD move sends Argentine dollar demand to the highest since 2019, which is a funny way to phrase it. Bloomberg doesn't talk about how Malay is lifting currency controls. They say it's increasing demand for Argentine dollars. But the bottom line is a previously socialist government, a previously a government that had devalued its currency so many times that that's really what you think of when you think of hyperinflation. Is stepping back and removing all currency controls, or at least that's what they say. So that's pretty funny. That's pretty cool. What's funny is that just a couple months ago on October 16th, Bloomberg ran a headline about the same thing, saying why Malay can't lift Argentina's currency controls. So just a couple months ago in October, Bloomberg was saying it's not possible for Malay to do this. 2 days ago, they're saying Malay did it. So take that with a grain of salt. The media still doesn't get it in many ways. All right, one last note before we move along to our DCA segment, and that is, of course, the conference in Las Vegas last week. And one of the people who first raised his head back in the Bitcoin space at Michael Saylor's 100K party and is now surfaced again at the Bitcoin conference was Trace Mayer. Trace Mayer was once the hodler of last resort. He's the one that started the Proof of Keys Day. He was certainly, he's responsible for the Mayer multiple. He was once a trusted name in Bitcoin, and then he torpedoed all of that at the Unconfiscatable conference in Las Vegas a few years ago, and he went around handing out slips of paper to people promoting a shitcoin. And I have mixed feelings about this. I believe in forgive and forget, and I would be more than willing to forgive Trace's transgression. Everybody makes stupid decisions. Everybody has bad days. Everybody has done things in their life they regret. Even somebody that was supposedly a Bitcoin maxi, like an original OG Bitcoin maxi, like Trace Mayer, is entitled to a screw up or two. But that's as long as you ask for forgiveness. You don't just get forgiveness. You have to say, I'm sorry, and you have to ask for it. And he has not. So I'm not quite willing to say that Trace Mayer has turned over a new leaf and that he's ready for forgiveness. So people posting their pictures with Trace Mayer at the conference, remember, we will embrace Trace with open arms, but he has to embrace Bitcoin again first. Not only has he not said sorry, he just went radio silent. He stopped tweeting. He just flat out disappeared. He got called out. He tucked tail and he hid under a rock and didn't come back out for a couple years. And then he just shows up at parties. He shows up at Michael Saylor's party. He shows up in Las Vegas partying at the Bitcoin conference. And he has never once said that what he did as a shitcoiner was a mistake. And that it was, and that promoting it at Unconfiscatable, which isn't just a Bitcoin conference, it is a Bitcoin maxi conference, a Bitcoin only conference, so that's all I'm going to say about that. All right, on to what makes today and every Wednesday special, and that today is DCA Wednesday. What is DCA, you might ask? Well, DCA is short for dollar cost averaging. And dollar cost averaging is an investment strategy where you invest your money in equal portions at regular intervals, regardless of price. So, for example, we DCA here on the podcast. We set our equal portion at just $20 US. Now, of course, this is a you do you thing. I chose $20 because it isn't that much for a lot of people who are listening to this podcast, but I wanted to show that if you're in a situation where $20 is a lot of money, that even if that's all you have is just $20 a week, that you can build a significant stack of Satoshis over time. And our regular interval we chose once a week, weekly on Wednesdays. That worked out really nicely for a weekly podcast, and DCA Wednesday has a nice ring to it. But again, this is a you do you thing. Most of my friends that I know, when I had a fiat mining job, most jobs that I've had in the past have paid every other week. So if that's the case, maybe you DCA every other week. Again, that's a you do you thing. The key is that you pick up a specific portion of money that you can afford to invest every weekly or whatever interval is, that is money that you're not going to need for food or rent or to pay an emergency medical bill. It's money that, that you can set it aside and forget it, that you intend to make disappear for at least 4 years, at least one full cycle, if not more than 10 years, and that you can continue to stack that equal portion regularly for infinity. So this is now going to be our 202nd stack. We began this experiment all the way back on Wednesday, July 28th, 2021. So not quite 4 years ago, but getting really close. And so far, we've stacked 201 Wednesdays at just $20 US a Wednesday. But that so far, that's totaled $4,020 US because it adds up faster than you might think. And that has purchased us a stack of more than 0.1 Bitcoin, 10,711,347 Satoshis to be exact. And we stacked that at an average purchase price of just $37,530.29. And that is because, we started stacking between that 2021 double top. We stacked all the way up to the all-time high of 69,000, and we stacked all the way down to the low in the teens. And now we're stacking all the way back up to where we purchased pretty close to the all-time high so far this time around. And we're going to continue to do so. And if the cycle repeats, we'll stack all the way down again during the next bear market. But the point being, by not trying to time the market, we have an average purchase price of just $37,530 US, as opposed to, YOLOing in and trying to time the market, which would have been around $39,000, almost $40,000 when we first started. And of course, we wouldn't have had $4,000 to YOLO in back in 2021 if we are in a situation where we can only stack $20 US a week. So let's say we'd YOLO'd in, $500 a time every 6 months or so. Our average purchase price would be even higher. So I think we've proven that the old adage that says time in the markets beats timing the markets works every time it's tried. And that's been the case for us, at least. To add to the stack, we are once again going to use Strike. Strike is not a sponsor of this podcast. We used to use Cash App, who also was not a sponsor of this podcast, but they recently doubled their fees, and so I decided that was enough because Cash App was already not the cheapest method for acquiring Bitcoin, but since we were stacking just $20 US, and because they had other things like letting us transfer our Bitcoin without a mining fee, the fact that they charged a little more kind of came out in the wash. But once they doubled their fees, it was no longer worth it. So now we're stacking with Strike. Strike has a few different rules than Cash App. They charge a 1% fee, which is certainly less than the 5% we'd be paying if we were using Cash App. They also charge what works out to about a $200 spread. So whatever the price of Bitcoin is, we're going to pay that 1% plus a couple $100 more than what the actual price of Bitcoin is, but still significantly cheaper than what Cash App is currently charging. So we're going to use Strike. This is a you do you thing. Strike might not even be available where you're listening. What's important is that you use a name brand exchange, one that's not something that you've only just heard about on Reddit or Twitter. and that you get your Bitcoin off of that exchange, because even reputable exchanges, even exchanges that we think are the strongest exchanges in the world, can potentially go away or do something wonky or get hacked or who knows what. But none of that matters if your Bitcoin's not on the exchange. So buy the Bitcoin, get it off the exchange when you have enough that it's worth moving. Obviously, I wouldn't send $20 of the Bitcoin, just 18,000 Satoshis or whatever that's going to work out to a hardware wallet, because when fees spike, we might find that that becomes completely unspendable. So again, this is a you do you thing. But once you have 100 or 200 or 1,000, whatever your threshold is, saved up, get it off the exchange. I've told people at a couple Bitcoin meetups and friends of mine that I wouldn't keep any more Bitcoin on an exchange than I would feel comfortable keeping cash in my wallet. If I lost my wallet and it had $100 in it, I wouldn't feel like flinging myself off a bridge. It wouldn't be the end of the world. But if you lost your wallet and had $100,000 in it, you might be pretty distraught. So whatever that number is for you, that's a you do you thing. For me, I like to transfer, maybe 250 or more US dollars to my hardware wallet. Others recommend don't transfer any less than, say, a million Satoshis. Again, that's a you do you thing. But the important thing is I have $20 on Strike already, and I've got Strike open. So it's just a matter of tapping on buy, entering 20 US dollars, tapping confirm, and voila, we've purchased another 18,843 sats. That is about 500 sats more than we purchased last week, because Bitcoin's down in price. Last week we bought at 108,000, a little more than 108,000. This week we bought just over 105,000. That's that spread I was talking about. The price of Bitcoin's not quite 105,000, it was like 109,000, 104,940, but with the spread, we paid 105,381, which is still not too shabby. We got 18,843 Satoshis, which brings our stack up to 10,730,190 Satoshis. Of course, that raises our average cost basis by another $120.49, but our average purchase price is still just $37,650.78. Obviously, significantly cheaper than 105,000 US dollars. But what's really cool is our total stack is worth about 11,000 US dollars, considering we've only stacked 4,040 US dollars now at just 20 US dollars a week. And of course, you ain't seen nothing yet. We're going to keep stacking. But when Bitcoin eventually hits the $1 million mark, which there are plenty of people who have forecast it will do this cycle, if the cycle really does repeat 2017, that is not out of the question. I think that if we hit $500,000, I would just be ecstatic, and that maybe we hit $1 million next cycle. But again, I don't have a crystal ball. All I can tell you is that it will hit 1 million US dollars eventually. I believe it will, at least. And when it does, our current stack of Satoshis would have a US dollar value of $107,301.90. An incredible return on just 40,040 US dollars. But again, it's not about the fiat return. It's about those Satoshis. It's about having a piece of the next global economic system, permissionless money that you can send anywhere in the world, life savings that you can flee if you find yourself in a situation where you need to flee a war or a famine or an authoritarian government. Try taking $107,301 worth of gold and smuggling it across the border somewhere. Adam Back's prediction of 10 million US dollar Bitcoin, I believe he said that was going to happen in the next halving. If that were to happen, that's pretty darn optimistic. But if that does, our stack would be worth more than $1 million US dollars, $1,073,019 to be exact. And who can forget when Fidelity's director of global macro, Jurian Timmer, said that they believe Bitcoin will have a US dollar value of $1 billion by the year 2038. And when that happens, if and when that happens, our current stack would be worth $107,301,900 US dollars, which would firmly put you in the elite of the new financial system, which would be pretty incredible considering you secured that seat at the table in the new global financial order for just 4,040 US dollars. Of course, if $20 a week is nothing to you, and you've been stacking more than $20, you would have significantly more Satoshis and be even better off when hyper-Bitcoinization occurs. All right, I was trying to keep this a tight wrap because right before I started recording, I had it's been one thing after another. Last week, I had an electricity issue with a building that I do business in, when I was trying to record there instead of the studio. And this week, I had a minor plumbing issue creep up in my house. My home isn't quite as old as that building. The building with the electricity problems is almost 100 years old, sitting right across the street from the beach. So, salt air. The elements are really hard on a building, even if it weren't almost 100 years old. This building is nowhere near that old, less than half that old, but it certainly has its fair share of problems. This house, that is. So I'm going to have to duck off and figure out what is wrong with the toilets. But before I go, I would like to once again ask you to help boost this podcast by feeding that algorithm monster. That is, if you enjoyed listening to this episode, please do me a solid and give it a 5-star review and share it with a friend or family member. If you're in a country that's not listed in the top 10 by sharing it with a friend or family member, you might just bump your country into the top 10. But as far as we're concerned, what you will be doing is you will be boosting us in the search results. So the more reviews we get, the more listens we get, the more people listening, the more likely plebs are to find this podcast when they're searching for Bitcoin content to listen to. And who knows, maybe by rating or reviewing this podcast or sharing it with a family member, you'll help orange pill somebody. Maybe somebody who thinks all they have is $100 and they're too late to Bitcoin. So is it even really worth it? And they'll listen to this podcast and say, wow, they're stacking just $20 and they already have a tenth of a Bitcoin. Maybe I'm not too late. You can also help support the podcast, feeding that algorithm monster, by making sure you're following us on Twitter or X. On Twitter/X, we are at BTC Bulletin Pod. Again, the more followers we have, the more likely people are to be exposed to this Bitcoin content. Of course, more importantly, I also love hearing from you. So if you do follow us on X, my DMs are open. Please give me a shout out on X. Let me know what you thought about this episode. I have my DMs open right now, and I do respond to our DMs. If you don't use Twitter, of course, you can always send me a good old-fashioned email. And the email for this podcast is bitcoinbulletin@protonmail.com. That's bitcoinbulletin@protonmail.com. Of course, you can continue supporting this podcast just by listening. So along those lines, don't forget to join us next Wednesday and every Wednesday as we continue our Bitcoin DCA journey, stacking just $20 at a time. But until that time, keep on stacking those sats, you sexy sat stackers.